we'll call this 2 weeks left in the year, roughly.
Yep.
Time's running out. Did you accomplish your New Year's resolution from this year?
I failed horribly.
What was it? Remind me.
I said that I was going to make a better effort to like get in touch with those that are kind of closest to me and make an effort to, meet up with them, hang out more. And
you've just been radio silent for everybody.
It's been bad. It's been bad. It's been bad. I think there's a little bit like during the weekends, it's just you get into this complacency, and I got things to do, but like that's not an excuse because I'm not a big believer that everyone's too busy for like I'm a believer that you can figure out how to carve out time for things that you want to do. So that's not an excuse. That's like purely on me in terms of a failed New Year's resolution. I will say we do got a couple of things like lined up for 2025. So I am happy that there's some stuff on the calendar already to maybe make 2024 resolutions come true in 2025.
Oh, I see. Like you got things to do with people.
Yeah, more like family, directly with family, some things to do for longer periods of time. So, and I actually do have a couple of things with like even my parents, and trying to do some stuff at the end of this year too. We're going away on like a little weekend trip, so I do got to go out towards some of my friends though a little bit better.
So, are you just going to run this New Year's resolution back for 2025?
It's like an easy one, right? Like, I mean. Yeah, I really should because, if you didn't accomplish something that you had on, the prior year, why would you move on to something new anyway?
Yeah, I guess that's one way. That's a good way of looking at it. One of my New Year's resolutions last year was read a book every month or consume a book. It could be audiobook, could be reading. I didn't do that. So I'm going to try it again.
I thought you did like fairly well though.
Yeah, I mean, I've done a few, but like not what I wanted to do. Certainly not 12 in the year.
What was your number?
I think 4.
Oh, okay.
So, I could have done much better. And I plan to do much better. More reading, but it's interesting. Some of my goals took on a life of their own. And so, I wanted to get healthier. I did. Although that's kind of a never ending goal, right?
Sure.
I don't know. I'm kind of still percolating. I ran my first 5K ever last weekend. And I've already signed up for another one.
Yeah, so it's almost as if you just had your New Year's resolution this year to be like, which is on a lot of people's resolution, which is healthier, lose weight, get more active, all that stuff. You would have hit that with flying stars. So like, I
would have hit that, but it's easy to do like backward looking. I don't know. This sounds silly because you're like me, Ryan. We're planners. We plan stuff. We organize things. We set out, we map out a plan and set a goal and then a roadmap to achieve it. But for a lot of this, for whatever it's going on, I'm kind of just, especially with this health stuff, not just health, but fitness, all this stuff. I'm just kind of careening right now and seeing where it takes me, whether it's lifting weights or running or whatever it is. And despite not having a concrete goal, I'm still got plenty of momentum, I think, working for me. So we'll see.
What race are you signed up for?
What's that?
What race are you signed up for?
I don't know. I did the Jingle 5K and they invited, then I'm on some email list and there's like a coffee run.
Oh yeah.
I don't know what that is. But it's at Woodward Park.
Yep.
It's right after New Year's. I figured why not? And so I've been looking, what can I do to improve my time? And I know it's it's only 4 weeks away and I can't expect a whole lot to go on in 4 weeks, but I kind of started to map out maybe how I can do that.
Okay.
You
definitively could talk to my wife. She's all about time and improving time and how to do this and how to do that.
I really don't. I think I have different fitness goals than being a runner. Yeah, and it's not that I don't like it. I actually have come to kind of enjoy running a little bit more, but that is not my goal. It's more like general fitness and building muscle and doing stuff like that. Running really long distances, while it's super impressive, isn't really on my to-do list.
Sure.
So we'll see. But getting better always is. If you're going to do something, you might as well try and better.
Yeah,
right?
definitely.
So we'll see. I don't know where this year takes me as far as those goals are concerned. Certainly improving, reading more. I don't know. The jury's still out. I still have 2 weeks to sort this out. Right.
Yeah, you have 2 weeks to read 8 books and.
Well, that's not going to happen. That's not going to happen. But I've got 2 weeks to sort out whatever my 2025 New Year's resolution is going to be. So, if we've got comments on this, I'll just say it right now and you're listening. Type in, if you're watching on YouTube, or hit us up at info@FordFG. I want to hear what your New Year's resolutions are, or if you've got one, what it is. I could use some inspiration here. I'm curious to hear if you're listening to this and if you're willing to share. I want to know what everybody's New Year's resolutions are. Some people bash these things as being silly, but I always think it's a great time to reset, take inventory, and plan out, the next year.
Yeah, I think it's good if you can come up with something that's realistic, doable, and something you probably should be doing, right?
Yeah.
Yeah.
Improvement should always be on our minds.
Correct.
Okay. Well, I think that's a good place to start. We'll check. This is going to be our last podcast of 2024. So by the next time we run one of these, we'll already be probably a week or two into the new year. So we'll be able to check in, take inventory on what these New Year's resolutions are and how we're doing on them so far. So, all right, Ryan, you ready to dig in? We're going to do some Outlook 2025 stuff. You ready?
Yep. Let's go.
Okay, let's do it. Welcome back to the Financial Casual Friday Financial Insights Podcast. I'm Brian Ullman, a certified financial planner and financial advisor here at Ford Financial Group, joined again by Ryan Louie, a regular CFP financial advisor here at Ford Financial Group. If you are watching this on YouTube, I'd encourage you to subscribe. If you're listening on Apple Podcasts, Spotify, I'd encourage you to subscribe on there. In this podcast, we really kind of talk generally about what some of the financial planning and investing issues are that's going on right now, and what we're seeing a lot of, and we try and answer kind of on a broader scale what questions we're hearing a lot from clients right now. But for today, we are talking. It is that time of year for Outlook 2025. So let's just make this a quick one. Ryan, what's the S&P 500 going to finish at next year? No, I'm kidding. It's interesting though.
You put me right.
Have you read some outlooks? Have you been doing some of that?
I've heard a few, just more like podcast type stuff than anything. Not a whole lot, just because I do feel like it's a bit like everyone just rubbed their crystal ball, and some of these firms then go and they change it mid-year, which is, I guess, fair because things do change. But also, if you change too drastically, it just means that you got the first 6 months completely wrong, and now you have to completely pivot because you weren't close to what your marks were. So I take it all with kind of a grain of salt.
I think a grain of salt.
So keep the same in mind with my numbers as well and my thoughts. But I'm
going to give us the number
with let's call it somewhere around 6,400, 6,500 on the S&P. I'm seeing something like a high single digit, 8% return might be a realistic return for me for next year.
I even think that's probably optimistic. I don't have a particular number in mind. I think with these outlooks, I think everybody should be honest with everyone else and say, we can't tell the future. There's no crystal ball. We don't know. Who knows what's going to happen? I don't think anybody thought that like AI was really going to be part of the discussion the way it was this year and having it be top of mind. I don't think, we knew an election was coming. We didn't know how it was going to go. Like there's so much that goes on every single year, and there's just no telling. And so, yeah, I think the reality is 2022 was a really nasty year. And so that got a lot of fluff out of the market, but also 2023 and 2024 have been really good years. And I think a lot of really exceptional good news has been baked in. And so that's, I think it's going to take a lot to get us to what markets have us priced in at. In fact, now might be a good time to check in on markets here. I'm going to share my screen here. Just bear with me. All right, here we go. This is year to date. We're checking in on the Dow. This is through kind of The close on the 17th of December, S&P 500 up 28% on the year. NASDAQ up a little bit more than 32%. Dow had a tough stretch here lately, but still up almost 16.5%. Aggregate bond index up less than 3% on the year. So a spectacular year. And you look at the last 3 years and man, it's been ripping basically since October 2022. Right.
Right. Yeah.
You just got to wonder how much is left. How much is left?
Well, you get running hot for 2 years. I mean, when you look just at the total returns for 2023, 2024, such great returns that realistically, we it's hard to tell clients, and you wouldn't want to tell clients that we're going to keep up at the same pace, because I don't think that, and you don't think that that's realistic for us to have, basically a third year of these kinds of returns.
Is it possible? Yeah,
absolutely, always possible.
Anything is possible on both ends of the spectrum, right?
Likely is probably less likely to happen.
Exactly right. I think it's interesting that yields have been stuck higher. In fact, there was one of the chief investment guys at LPL was saying that it's possible. They're actually responding to another analyst saying that it's very possible that we're going to have 6% on the 10-year treasury, which was going to be an interesting development. We've got a Fed meeting tomorrow. As of we're recording this, there's a Fed meeting tomorrow. There's a lot of uncertainty about what the Federal Reserve is going to do next year.
Sure.
Right. I think there's consensus that they're going to cut rates one more time here in December, but do they cut at all next year? Do they cut 4 times? Do they cut 7 times? I mean, I think there's
it's all over the place, really, in terms of what some of the guidance is.
Yeah. So I think if we're going to be intellectually honest here, we've got to say, okay, we don't know. We have to admit that we don't know what next year holds. So we'll start there, right? But LPL, who we partner with, like everybody else, comes out with their outlook for the next year. And in a nutshell, they say they're cautiously optimistic. Mostly because they think that, tax policy and deregulation efforts can give some tailwinds, especially from an economic perspective. They concede that returns probably won't be as good next year as they are this year, but that's kind of it in a nutshell. So they cover they cover 7 areas: economy, stocks, bonds, alternative investments, which we may touch on, commodities, and currencies, which we're kind of limited on what we can say there, and then geopolitics. I think that's a total crapshoot, but they address it also. So we're going to try and go one by one here on these and talk about what LPL has to say and our reaction to it. And that's kind of the path that we're going to take here today as we close out the year. So this is not necessarily our outlook, although I think that will probably come out in the discussion, but our reaction really to LPL's 2025 outlook.
Yeah, just some of our thoughts based upon what we've read and hear, and we can add some context maybe, or add some other thoughts.
Exactly. Okay, so we're going to start with the economy, and they say they recognize the economy's had some significant shifts over the last couple of years, including aggressive rate hikes. That was really kind of blew out 2022 in a negative way. But inflation's come down, and they expect the economy to downshift throughout next year through kind of slowing consumer spending, which we're already kind of starting to see. But there's still pent-up demand for business capital expenditures. Favorable tax policy is something they expect, which is to say an extension of the 2017 tax cuts. Deregulation could help, but inflationary pressures could reemerge, which could kind of slow interest rate cuts. And they also say the labor market's starting to show signs of slowly shifting, I think, in a negative way. And so they say what happens with the labor market is key to how the economy lands. It strikes me as a whole lot of hedging and word salad without
Yeah, I think that all what they did was basically lined up a few items to say these are the positives, right, that can happen, and then
Yep.
on the other side, counterbalance that. Here's some negative things that can happen, and I mean, technically, it's all true, right?
Yep.
Because the labor market's really important, and
Sure.
interest rates, if they were to go up, here, we're
Right.
talking about unemployment. Those things are our concern, and if they become prevalent, then even if you have deregulation, which could be really one of the major things that could spur the market if it works out right. Maybe it helps M&A and some of these
Yeah.
other areas. We do know that as lower interest rates have happened, that does help small businesses maybe start to spend a little bit more money. So
Yep.
there's some things that definitely are positives for the market, but you could always come up with some counterbalances that could come up and be problematic for the economy.
Yeah, I
And
think
this is one of them.
Yeah, this is one. Well, unemployment, I've said this over and over. You look at this and you say, oh, we're at 4.2% unemployment compared to a historical average of about 6. Wow, we're in great shape. But the reality is we're trending higher. A year and a half ago, we were at 3.5, and now we're at 4.2. It triggered all sorts of economic kind of rules that suggest a recession's on the way. But even if we don't get a recession, I think we could very easily see unemployment rise next year.
And we've talked about this before. As unemployment rises, people do not have jobs, and if people don't have jobs, they don't have the money to spend, right? So that's where less consumer spending comes. Part of it comes from is that people don't have as many jobs.
Yeah, and unemployment has come. Oh, I'm sorry. This. We're looking at CPI here. If you're watching this recording, CPI has come down to 2.7%, down from, what was 8-9%. A couple of years ago. So inflation has improved, but inflation is not back to zero, which is where it was, briefly over the last few years, and is still well above where we were essentially since 2008. So, I think inflation could prove pretty pesky with unemployment rates starting to rise. I don't know if that's a great environment. I don't know if it's recessionary necessarily, but I wouldn't say this is a rosy economic picture. And maybe that falls in line with what LPL is saying, which is to say, things could be okay, but slower than last year or 2024.
Yeah. I mean, overall, hindsight says this was a good year, right?
Yeah, it turned out to be a good year, but
yeah,
for
really,
next
a really
year,
good year. With little problems. And so I think that realistically, if some of these other things just kind of creep up, it becomes more murky.
I mean, would you be surprised? I was going to ask you if you think we'll have a recession next year, but it's impossible.
I think I said that last time. Yes.
Would you be surprised if we found ourselves in a recession in 2020?
I would not be surprised. I would not be surprised. I mean, things aren't so good that it can't happen. So I shouldn't say surprised. I might say right now I'd still lean towards it not happening percentage wise.
Yeah.
Odds.
We'll see. I mean, we just had our last yield curve uninversion where the 3-month uninverted from the 10-year, or was it 10-month and 2-year? Whatever it is, I mean, these uninversions are usually, well, I won't get into it, but those are usually kind of more indicators that trouble could be on the way. Yeah. Let's pivot here. We'll take some of these charts off. We'll move on to stocks here because I think that's what a lot of people worry about. Even though so many people have as many bonds, or at least almost as many bonds in their portfolio as they do stocks, everybody always wants to know about what the stock market's going to do. LPL in their Outlook 2025 says for stocks, expect modest stock market gains in 2025, supported by a stable economy, solid corporate profits, a Fed that's no longer hawkish, which is old news, and some potential deregulation tailwinds. They acknowledge that stocks have priced in a lot of good news already, so it's positive, like upside surprises are going to be harder and harder to come by. They also recognize a repeat of 2024 is unlikely. I'd say really unlikely if I'm adding to this. But interest rate risk is still rising. Valuations are elevated. Geopolitical threats are still an issue. So they're essentially saying bouts of volatility will be likely. But here you go, Ryan. S&P 500 fair value target range is between 62.75 and 63.75.
Yeah. So that's like a 2 to 3% gain.
Yeah, that is not much.
It's a few percent gain. I've said this to clients, in terms of what the expectations should be for this year. And it's definitively the opposite things of what clients want to hear. And it's kind of the opposite of what they've experienced this year, which is, I think that people need to be ready for much lower returns and much more volatility, right? It's the exact opposite of what we had this year, which was really low volatility and high returns. And that's becomes, again, what people get used to is looking through the rear view, mirror.
100%.
And it's like, oh, but the last 6 months or the last 12 months, we had great returns. And then all of a sudden people get maybe in 3, 4, 5 months into 2025, returns aren't doing a whole lot. They are seeing a lot of ups and downs. Maybe they've had 2 up months with 2 down months, and they're like, this is bad. And it's a very likely case though of that's what we're looking for in 2025.
Yep. Yeah, I mean, look at this chart here. This is stock market pullbacks. This is the number of 10% pullbacks experienced by investors each year. This is the S&P 500, right? We've had 0 this year. 0. We haven't had an official correction in this calendar year, presuming that we don't get one in the next 2 weeks. We had one last year. What? It has been so serene. I know the world's coming apart at the seams. It seems sometimes if you watch too much cable news, you for sure believe that, but markets have been so quiet. And even if we want to say the number of 5% pullbacks, we've had 2, April and August. And one was because of that Japanese carry trade. Like, look at this. It has been calm. And so even if you can see here, we have an average between 1 and 2, 10% pullbacks a year. Let's say we get 1 next year. Let's say more likely that we get the average number of 5% pullbacks on the S&P 500 a year is between 4 and 5. Even if let's say we revert to the mean and we get 5% pullbacks next year, it's going to feel to people who haven't had to experience volatility for the last 2 years like we're getting killed.
Yes. So I'll give like an example of this. Back in April, which was the worst month that we had in 2025. Yeah. We had probably 6 months at that point, maybe 5 to 6 months of pretty, smooth riding prior to that. Bonds were going up, stocks were going up, things were looking pretty good overall. And then we had the April month. And I do remember for the clients that kind of came in May and June, they mentioned it. They were like, oh, that was really, it was really bad. It was really bad. And then I put it in perspective. It's like, yeah, it's, in 6 months you had one down month, it really, and it wasn't a horrible month either. It was just, it was down. But again, that's what we have set up for us going into 2025 is that clients are just really kind of used to this market of going up and no volatility. And that's the one thing I would prep everyone to kind of step away from is that this was the abnormal market, and we're not saying that things are going to be horrifically bad. That's not what we're saying, but we are saying that potentially could be more normal, and normal means volatility and, not always rosy returns.
Yep. It makes me think of like a flight, right? You're on the plane and the pilot says, please buckle up for turbulence, right? And so you buckle up and you're going to get there fine. The plane's going to land, everything's going to be okay. But the ride is going to be bumpier. And I think we're hitting that point of the flight where the ride is going to be a little bit bumpier, and every year, this is everybody's favorite chart, right? The annual returns and pullbacks. Our largest pullback was at 8% pullback from the peak this year. The year before it was 10%. So we met that metric of a correction. But it's going to be more of them, not necessarily bigger ones, but more of them. It would surprise me if I hate saying we're due for things, but an honest to God correction of 10, 12, 15% would not be out of the norm here.
No, I think that, again, the longer you run without having it, the more that you need to expect that one's going to come sooner than later.
Yeah. And you're right. Even on the high end, 6,300 for LPL's target for the S&P 500.
Not
That is
not
not
very
much
much more. You're talking about 12 months of time frame, and you have very little to show for it at the end. If that's the high end of the returns.
Totally. I mean, if the S&P 500 keeps doing what it's doing, we could be there. We could be there before the year is over.
Right.
For goodness sake,
Yeah.
right? Anyway, okay. So that's stocks, modest gains, lots of volatility. I think we can all maybe kind of agree on that projection, and that's not an outlandish look. It's just get ready, buckle up, know that it's going to be ups and downs. Let's talk bonds. LPL says bond yields are expected to remain elevated, with the 10-year treasury yield likely to remain between 3 3/4 and 4 1/4 over the next 12 months. They see roughly equal upside and downside risk to yields as the markets grapple with budget deficits, increasing treasury supply, and the scope of the current easing cycle from the Federal Reserve. So for fixed income investors, we want to focus on income generation and duration management. I know that's jargon. We'll explain it in a second. And they believe the most attractive opportunities lie in the 5-year maturity range. So what are we talking about here? For bonds, we are talking about mostly what's going on with yields and how that affects bonds. And so here's interest rates, the 2-year and the 10-year. They're talking about rates coming down. If we focus here on the 10-year rate, which on this chart is 4.39, they're talking about rates coming down maybe another 0.25% or so, but kind of staying there. We're not going back to where we were before inflation hit, is their expectation, which I think, Ryan, you think it's fair?
I think everything that they said is about right, and I think still, given kind of the yields that you get,
yeah,
even if you were to have maybe a little bit of a surprise in terms of bonds depreciating in value, again, you're probably going to be okay throughout the year. I'm not necessarily going to expect a ton of appreciation from bonds plus the yield. Like that's the high. That's the great side of something happening eventually with these bonds, is that you pick up some good interest and throughout the year, maybe you get a pretty good appreciation on the bonds. I'm not expecting that, but again, the yield's being pretty good. And if you play somewhere in the middle of risk or maturity, I think that you still walk away with, a fairly, admirable return. Maybe you're looking at the 4 to 5% range of a return.
You know what I like about LPL's take on this? What I like about this is they are not stepping out on a limb in any way with any of these projections. Like, you read this stuff and you're like, yeah. I mean, not too hot, not too cold. Rates will come down, but not as much as people think. I think, but one of the reasons why there's this recommendation of intermediate term bonds, or kind of intermediate term durations, the longer the duration is, the more you're affected by interest rates, both positively and negatively. So if you have a really long dated bond and interest rates come down, you're in business. If they go up, which is a possibility, then you can get really hurt. We all experienced that in 2022. And so they are leaving open the possibility for rates to go higher. If they're suggesting intermediate term bonds, because if they really thought rates were going to crater, they would say go long.
Yes, for sure. And on the opposite end, for those that you go super short duration bonds, interest rates continue to go down. You're not going to make money, and it's going to be lower and lower interest rates as that continues to happen. So that's not necessarily what they're thinking is the play either. I think probably for that reason, as interest rates go down, you're just not going to be able to get the same interest that you used to get or have been getting.
Yeah, and if you're owning individual bonds, right, then you can snap them up at a pretty decent rate and not worry about them losing necessarily. But if you're doing bond funds, which a lot of people do, I think the risk reward, like even if you were going shorter duration bonds and not intermediate term, you might give up some yield. But also, if you're owning bonds, it's because you're trying to protect yourself. So I don't think there's if anything, I would err on the side of being even shorter than they're suggesting, or more cautious. There could be some opportunity cost there, but really you're owning bonds for stability, and shorter would be more stable in this case if you really don't know which way rates are going to go.
Yeah, you're looking for something to counterbalance your stocks.
Right.
And so you definitely don't want some kind of repeat of 2022. I don't see that happening.
Right.
But that
Unless,
you definitely don't want that to happen, because that's both sides of the portfolio going down at the same time.
yeah, well, here's the reality. If rates really go down, it's because we're in a recession. So you can look, at the blue bars on this, and when rates are going down, it's because of a recession. And
Right.
that's on the 5-year, the 10-year, and the Fed fund upper bound rate. So,
And I've said this in the previous podcast, I do expect bonds to act more normally if we were to hit some real turbulence with the economy, which then means, yes, maybe a recession's here, stock market's going down. I do think that the bonds start to play more like themselves again, or
sure.
historically like they have in the long run, where they do offer you that protection.
Yep. Yeah, and you can see in years, we bounced back some, but in years where rates are going down like they did in 2019, 2018, 2019, you can see the returns. The total return on the aggregate bond index was 9% and 8% with some drawdowns in there. I just think it's I don't want to say we have like this binary result, but either we hum along and we avoid a recession and interest rates don't really come down and we kind of continue in this lukewarm, like mid-single digit returns for stocks and bonds, but unemployment doesn't really go higher, or unemployment really starts to crank up and inflation's pesky and they have to leave rates higher, and that does tip us into a recession, because a recession will solve our inflation problems. And once we're in a recession, then you have yields. You're going to have the market really turbulent. You're going to have yields coming down pretty significantly, and that's going to be good for bonds. So you either get it seems to me that you're either going to get really lukewarm returns out of your bonds, or if you get good returns, it's because the economy is starting to come apart. We have a recession.
Yeah. So realistically, for those people that have like a balanced portfolio, a good mixture of stocks and bonds, you don't want this. You don't want the scenario where the bonds are probably really excelling in their returns, because that means, again, you're making some good money on your bonds, good relative for bonds, but you're losing probably a lot on your stocks, and so that you're not going to get that 1-to-1 ratio of the bonds. That bonds are holding up their own for everything that the stocks are losing.
Yeah.
Best not to go down that road.
No, I agree with you. It'll be interesting. It's very, no one knows which way this is going to break, and it can break a couple of different pretty important ways, I think. I think some of this is going to be about staying nimble, right? We don't time markets here, of course. We're not so bold to think that we can predict the future, but you got to take what the market's giving you. And if the market's moving one way or the economy looks like it's moving another, you kind of got to be able to
make
adjustments, right? So we'll rattle through a few of these. We don't have any charts to accompany these, and so we'll move. We're a half hour in, so we'll move kind of quickly. They talk about alternative investments, with lower interest rates and policy shifts, like market neutral, global macro, managed futures can kind of capitalize on volatility and market dispersion. And so there's some opportunity there, perhaps. And private credit infrastructure remain attractive. I think some of what we're talking about, if there's this place where bonds and stock are doing poorly, maybe there's some alternatives that can help you maintain some decent kind of
returns overall. Some of these alternative investments, you don't want the wild ride, but if, let's say, next year, again, maybe some volatility, but overall the returns relatively stagnant from beginning of the year to the end of the year, some of these could give you pretty decent yield. And so in a market where the stocks go up 3%, maybe going yield that goes up 6 or 7 looks really good. Doesn't look so great in a year like this, right? Because the stocks have done so well. But in a year where returns are more muted, some of these other options at the end of the year may look pretty decent.
Yeah. In fact, kind of in that vein, LPL recommends, they have a positive view on commodities as a diversifier for a few reasons. There's kind of commodities are required for kind of infrastructure projects globally. Because there's aging infrastructure across the globe. I'll say separately, we can't get into what commodities are being used, right? But central banks around the world are trying to diversify their reserves away from the dollar somewhat. Not get rid of the dollar. No, nobody go crazy here, but diversify that. So there's some demand there, right, from central banks. So the LPL says commodity exposure should be a small portion of a portfolio that's diversified. But so it's interesting. I think this is more concession that we don't know what the future holds. So you kind of got to spread it out.
Yes. Have a little bit of different things that all may be able to work for you. It gives you diversification. Again, if things are volatile, maybe some of these diversification types of investments can help.
Yeah. They get into currencies as well because the dollar kind of continues to reign across global currency markets. So solid economic growth, especially compared to other developed countries, has been really a driver of strength with the dollar. Uncertainty over the trajectory of inflation, expectations for gradual easing from the Fed, and positive interest rate differentials have supported the dollar. I don't know. We'll see. Tariffs could elevate the currency market volatility and stoke inflation fears, which would put additional upward pressure on the dollar. So they think the dollar will be well supported for next year, and there's not a whole lot of downside risk. How that translates through into the portfolio. We'll see, but they're predicting a continued kind of strong dollar for next year for currencies.
Yeah, I don't think that, a large part being in the US, you don't focus too much on currencies. Obviously, the investments are denominated in the US dollar. And so therefore you're not at risk if the dollar is going up and down so much as maybe you are if you were in in another international investment, or, consequentially, we have the option to choose international investments sometimes in their currency. Then you do have risk of like, what does the dollar do versus someone else's currency? But this tends to be not something that we have to focus on too much.
Yep. The last thing they focus on is geopolitics, because we've got a shaky geopolitical landscape punctuated by military skirmishes, armed conflicts, clearly defined wars when you're talking about Russia and Ukraine, Syria, and kind of the power vacuum in the Middle East that's going on there and the turbulence there. Europe is turbulent as well. You've got these snap elections going on. And the U.S. markets have performed with distinction, driving the bull market that we've had for this last year or two. And we still have a solid economic backdrop. What do they call it? The cleanest dirty shirt in the laundry, or the best house on a bad block, or whatever you want to call it. Being invested in the U.S. has allowed you to kind of be able, as an investor, to ignore some of those geopolitical things. And they think that will remain. I very much would agree with that also.
Yeah, I think that we've had a lot of, things happening in the last couple of years with geopolitics and kind of the skirmishes that are happening right now. But if you were to look at a chart, you wouldn't really notice that there's been problems with all of these geopolitical issues. So it definitely feels bad. It's concerning, but the market's not, reacting towards it, not at this point. And
wouldn't you say that like the last real market reaction was when Russia invaded Ukraine
and it was so small. It was short. Like it was, what was it? Like a week or two, it felt like, and then the news kind of moved on again. And so I would say that
2022. It was well, I guess it wasn't 2020. Russia, it's been going for 3 years now, right? So
right.
2021 then that this happened?
2022.
2020. Oh, 2022. Yeah, because we're going into 25. So so that was, as markets were starting to unravel in early 2022, a lot of that related to interest rates. Russia invading the Ukraine didn't help anything, of course. But
correct.
That feels like it was the last kind of reaction to some international geopolitics in a major way.
It feels like things would have to be really large and consequential.
Sure.
Obviously, compared to what we've seen so far, that hasn't moved the market too much. So it's going to have to be a much larger scale than anything we've seen the last few years.
Like we're talking something with China or something. I don't know.
Yeah. And we can't. It's too hard to speculate. Now, I will also say this. Where it could become, more concerning, sort of like it was maybe in 2022, was when a market's already going down, right?
Yep.
Then you're adding fuel to the fire because things are already troublesome. And then all of a sudden something flare up happens geopolitically. It just exacerbates the scenario.
Right.
So that could be more concerning. But again,
Very
if the
much.
economy is tending to chug along, I think that the market tends to kind of distance itself from all the geopolitical issues.
Yeah, I mean, unemployment, recession, interest rates, all that matters more to when we're talking geopolitics, is how does it relate to X, right? If Russia's invading Ukraine, markets were reacting to the inflationary part of this stuff, right?
Yes.
Energy costs moving higher, price of wheat, fertilizer, that kind of stuff. It wasn't so much the war itself. And so I think that's where the focus is. So geopolitics probably and also ran in this discussion where it can be influential, but not really driving things so much. I don't know. And it's messy. Like there's no telling what's going on. Okay. Well, I guess to summarize here, right? We're talking about volatile yet lukewarm returns in equity markets, probably less volatile yet lukewarm returns in fixed income markets. So buckle up for a ride to nowhere. Right? I mean, I don't know.
Nowhere's not bad. Like I said, you always want to make progress, but
Sure.
if a year was pretty muted and we made maybe a few percent, it's not obviously the end of the world. Making something's better than nothing. So maybe that's what we have in store for us. And honestly, it feels kind of odd.
I will tell you,
bond returns might be just in line with the stock returns as far as some of the expectations.
Could be. I think markets. There are years where markets rip. This is one of them, right? 2024 is one of them. 2023 is pretty good too. We don't have the chart teed up, but this reminds me, it's being invested regardless. You don't know when market's going to rip, so you need to be invested so you can be part of it.
Right.
So people who are making their investment strategy based on who occupies the White House, for example, if you did that, if you didn't like the president that we've got right now, and you were sitting on the sidelines for most of 2024, you missed out on a lot. If you don't like the president that's coming in January, there's some potential for you to miss out on a lot. Maybe not next year, but the year after or the year after that. Right. So, you need to be participating when the market's ripping, because that's where your gains come. And that's where you get these average returns of like 9% in the S&P. It's because you have good years like we had these last two, or a bad year like we had 3 years ago. Importance is being in the market. Okay. Let's close out the year with what's on your mind beyond your resolutions here, Ryan.
Okay, well, feels like a little resolution-y, but
okay.
So I'm trying to get back onto my exercise routine. So a real kind of quick recap of this year was that I was going to the gym I had classes that I've been going to for years now, and the gym ended up closing in early June. Okay. So that derailed my routine. And so I thought, okay, well, I belong to the pickleball club, the racket club. I could just go into the gym in the mornings and kind of do my thing. And like for a lot of people, it was okay, but it wasn't nearly to the kind of workout that I need to be doing.
Okay.
So I went to a free class. This is right by my house. They had a couple of classes I could try out, and I went to it last week. And I said, okay, sign me up. It's something I got to do. And I show up on Monday for my first actual paid class, and the owners there having to talk about how they are selling the place, or they're leaving. And so my very first day of actually signing up, joining this new gym, the club.
What gym is it?
It's Title 29. It's over by the Bullard Loop. It's good. They're not closing. So they're going to try to, I think what they're going to ultimately do is try to manage it until they have some kind of transition where somebody that's kind of internal, they're hoping that somebody like this, one of the coaches will end up taking it over. It seems like a good place. I like the workouts. It's just by chance, my first real day, they had to talk with all the members about all the, basically pivoting where they are. So we'll see where it goes. But I'm still optimistic that, it'll be there.
What kind of workouts are we talking about here?
It's strength and hit depending on the day.
Okay.
I will say the very first day that I tried the actual trial membership, they had something called the 12 Days of Christmas. So you actually did a run around the building, and then you do 2 of something. Then you go 3, 2, 1, 4, 2, 1, 5, 2, 1. They were like, this was absolutely the wrong day that you came to try this out, because it was grueling.
It was a grinder.
It was a grinder. I was sore for like 3 days, so I didn't go to try my second day that I had for a trial for several days afterwards.
Yeah. Interesting. That's a bummer that you joined. You would think that they at least would stay afloat for long enough to get a bunch of people to sign up in January, February.
Yeah, no, I think they will. Like, I think that the gym is going to be fine. It was just an interesting time to show up for my first day, and basically the owners are maybe handing over the keys to someone.
What took you to that gym? What brought you there?
Just location. I need something close because I'm going to go at 6. And so I go 6 in the morning, and then I need to hurry up, get back, and get ready for work. So can't be too, like, if it's a 15-minute drive one way and then 15 another, it'll deter me from wanting to go.
Yeah.
Yeah.
So that's interesting you say that. So I've got a couple things on my mind. I'll start I'm going to piggyback off of what you said. And then I'm going to share a couple of shows on Netflix that are awesome. But I'm with you. I'm continuing this workout thing. The only other person that knows about it, I think, is Joe Perry, because I sent him a picture. So I have it on good authority that I've got a Christmas gift coming that is going to allow me to continue my workouts at home. Specifically a rower, from, don't tell Jen I saw my Christmas gift.
Yeah. Hopefully she doesn't watch the podcast.
She's not watching this. Anyway, so yeah, if I have to drive a half hour at 5 a.m, it's not going to happen. So I can step right out in my garage and make it happen. So for me, everything's always proximity. So I got a rower, I've got some sandbags. I'm doing some less just full blown weightlifting and more like CrossFit-y type workouts.
Okay. Wait, you have sandbags for your house to like rucksacks or whatever to
exactly. Okay. And some kettlebells and some other stuff too. So I'm
going to be seeing you run with like weighted bags down the Christmas tree lane. You're going to be that guy that's gonna be doing cross training like out in your neighborhood.
So not weighted bags necessarily, but I do have a weight vest.
Oh, okay.
So
that's a little less conspicuous.
No, it could fit. I know Joe has a weight vest. I think he wears it on the outside of his sweatshirt. I will wear mine maybe under my sweatshirt, so I don't look like I'm like the tactical dude running around the neighborhood. But hold on. I can throw that on for running around. I have a Sunday workout that I do with my weight vest on, but the rowing machine is really what's going to kind of kick into gear, do my cardio on that. So I'm excited about that. But importantly, I'm signed out. There are 2 shows on Netflix. I know you haven't taken my recommendations this year at all.
I know.
I think Black Dove is one. Spy.
Doesn't sound familiar, but
spy thriller kind of situation.
Okay.
And then another one called The Diplomat.
Is The Diplomat a new one?
No.
Okay. I actually think I've seen some episodes of this.
Okay. Season 2 came out. Clearly they had their budget increased, because I would say season 2 is better than season 1. Season 1 was solid. But season 2 is better so far. I'm only a couple episodes in. It's great. Black Dove, also really good. Keira Knightley, who you don't think of as like Jason Bourne kind of spy. Clearly I've got a thing for spy shows. But it's great. It's really good so far. So if you're hanging these next couple of weeks, you're home, the days are dark early.
It's dark. It's wet. It's wet outside. You don't even want to be out there.
I feel like my tennis is going to get canceled today. You got to dial up the Netflix. So in between watching bowl games or whatever you're going to do, or I think I've watched the Christmas Vacation movie 3 times already this December. Mix in some of those shows, and they're solid.
Yeah, it's always good to have a good recommendation, because I think the problem is for us too is that if you don't have somebody that recommends a few that you could actually, you have to remember the names too. That helps. But we could always text people that have mentioned it.
Yep.
You're just searching for blindly. You're like scrolling through Netflix, and it's really hard to actually find something and commit to something.
Right.
When all you're doing is kind of looking at a picture and a quick paragraph on it. So
Yep.
it really helps to have at least someone give some recommendations when that time comes.
It is the time. I'm not much of a basketball guy. Full disclosure. Football is, the 49ers are out of it.
It's
so
over.
Football's kind of winding down for me. I don't care about the whatever bowl game. Baseball is months away. I got to find something else. And I think some of these shows are it. But that's also where the books come in January, right? Got to pick up.
Yeah, if it's not Netflix, then you could have some books that you need to read to meet your New Year's resolution for 2025.
Exactly. All right, Ryan. Well, happy holidays
to you as
Merry
well.
Christmas, happy Hanukkah, happy New Year.
We'll
until
be back
2025.
in 2025.
What's that? 2025. Yeah. If you are still watching or listening 50 something minutes into this, thanks for your support. Email us questions at info@fordfg.com. You can subscribe on Apple Podcasts. You can subscribe on Spotify. You can subscribe on YouTube. We'll be doing more of these. We'll also be including, for clients, our client webinars will be on YouTube as well. We've got some of those coming up here in 2025, which is going to be great. If we're doing volatility, let's talk more about it in these videos. I think will be helpful for folks. So make sure to keep an eye out for those. So until 2025, Ryan.
Happy New Year.
Happy New Year.